Hey there, this is Pat Ennis of Ennis Legacy Partners. Welcome to the Exit Readiness Podcast. I'm here with my co-host Walter Dial, CPA and tax partner at GRF, CPAs and Advisors here in Bethesda, Maryland. Our mission here on the Exit Readiness Podcast is to provide you, the business owner, with subject matter expertise on topics pertaining to building sellable business value and for planning your eventual exit from the business. We want to help you exit your business successfully and on your own terms and conditions. Walter, as you know, an owner who has sellable business value and who has accumulated substantial assets outside of the business has more options for exit. For example, you and I, we worked a client that this year completed a transaction to his son and a key employee. The business was sellable. He did a good job of building a sellable business in that it didn't depend on him and it was strong in a number of other value driver areas. But what he also did a good job of, the owner had also done a good job of accumulating assets outside of the business, which allowed him to first sell the business to who he really wanted to sell the business to, his son and a key employee, but also sell it at a price that was actually less than he would have received if he sold to a third party. But he had the flexibility to do that because he accumulated some assets outside of the business. So that's really what we're going to want to talk about here today, right?
Yeah, that's right, Pat. And you definitely make a good point. The amount of assets you have outside of the business, the more assets you have outside the business, definitely the more flexibility you're going to have in timing your exit and also in choosing the method of exit. So today we're going to talk about a retirement plan that many owners are going to be unfamiliar with. It's called a cash balance retirement plan. And specifically our topic today is cash balance retirement plans and how they affect your business exit. We have two guests today. We have Erik Fromm and Risell representing Janney Montgomery Scott. So Erik is a financial advisor from CSG Capital Partners. CSG Capital Partners of Janney Montgomery Scott has a team of wealth management advisors located right here in Washington, D.C. And Les is a senior retirement planning specialist working out of the Janney Montgomery Scott corporate office in Philadelphia, but we're not going to hold that against him.
No.
Both of these gentlemen
we might this week.
Yeah, we might. Both of these gentlemen have extensive experience with retirement planning for business owners, and Les brings added expertise specifically in the area of cash balance plans. So welcome to the podcast, Erik and Les.
Thanks a lot.
Yeah, gentlemen. Hey, thanks for joining us. We're excited about the topic because of the situation that I mentioned at the outside of the podcast here today. We've had at least one situation like that where a business owner's done a real fine job of accumulating assets with the help of an advisor like you, Erik, and you, Les, outside of the business. And so let's get started. Which one of you guys want to first describe exactly what a cash balance plan is and who would be a good candidate for it? And you know what else? Who would not be a good candidate? Who would be a good candidate and who would not be a good candidate?
Okay, this is Les. I'll take that if I may. A cash balance plan is an IRS qualified retirement plan, which is kind of a hybrid. Each employee or participant receives a contribution to an account, and it grows in two ways, by employer contribution and by interest credit, which is guaranteed rather than dependent on the plan's investment performance. So that annual interest credit is guaranteed and is not dependent on the plan's performance. It's usually around a 5% fix. Sometimes it's 4, 3.5, depending. The plan assets are pooled and invested by a trustee or an investment manager. And if the plan's investments earnings exceed the guaranteed rate, that excess can be used to reduce future employer contributions. Now, if that credited rate is not reached, then that shortfall has to be made up by the employer contribution, and we can typically spread that out over a couple of years. as far as who is a good candidate, typically it's a high income business owner who's really getting killed in taxes and who's looking for more deductions. We're assuming that he's already maxed out his 401k profit sharing plan, and he's as close or at that $62,000 statutory maximum. Doctors groups, dental practices, law firms, professional groups where you have a larger group of folks that you're looking to incent and a very small sort of rank and file staff. A group that would not be a good candidate would be a group with a large rank and file population, because everyone's in the plan, and owners who may not be at the point where they're maximizing their contributions to their current 401k profit sharing plan.
Okay, so follow-up question, Les. For the good candidates, the nature of the business in regard to revenue and consistency, stability of revenue, that comes into play, right? Because you're making a commitment, and again, if you don't live up to that commitment, you're going to get hit with penalties. And
that's a great point. So these businesses typically, like you said, are stable. There's great cash flow, and they're really just an owner who's looking for more to put away more money over and above the statutory maximum for his retirement plan, and is really looking for some help with tax deductions. And you are correct in that if you have to meet that minimum percentage increase, the bogey, we sometimes refer to that as, because if you don't, then you have to make up that shortfall. And this is not a short-term sort of option or plan. We want to keep this plan for at least 3 years. 3 to 5 years is what we hear. Anything shorter than that is going to look really funny to the IRS and is really going to invite an audit.
One more follow-up. And what about the ages of the employees, the owners and the employees? That makes a difference?
That's another great point. So this sort of follows the path of new comparability in profit sharing, if you're familiar with that. Cash balance plans work much, much better if the owner, the people you want to incent, are significantly older or somewhat older than your rank and file employees, and they're making substantially more money. A good sort of precursor to deciding whether you're going to have this plan or not is to get together with a qualified TPA who has an actuary and run some test scenarios to see what the numbers are going to look like. But again, that disparity in age and in income are pretty important.
So Les, in a lot of ways, the cash balance plan is kind of like the old-fashioned defined benefit plan.
It's sort of a hybrid. So it has sort of the benefits of both defined contribution and defined benefit, where you have that, it's got to be that 5% increase each year, but it's employer contributions. So it's sort of the best of both worlds, and it's a really good option to sort of add on to your 401k profit sharing plan if you're looking to put away substantially more money and you're looking for those tax breaks.
Yeah, I will echo what you said. I mean, most of our clients that use them, oftentimes it's like a one-person S corp. Sometimes maybe just a very limited employee group, making a ton of money, and really just looking for ways to reduce their taxes. So, I mean, we've had plans we put in this last year that the contributions were a couple, like $250,000, things like that. What is the actual cap on the contribution?
Well, that's a difficult question because there's a number, and it's somewhere south of 300,000. I'd have to look to see or figure out if that's going to change in 2020. But there's different sort of scenarios where that number can be greater than if you're trying to front load it, which, again, a good TPA and a good actuary will be able to do that. So you can actually go over that statutory maximum if you're trying to sort of front load it in year one and put in less year 2, 3, 4, and 5.
Yeah, so it's a really great planning tool for someone who maybe their income has popped up, so they're now in a new bracket, or maybe their income has just put them over the threshold to take advantage of some of the new provisions in the tax law, like the 20% qualified business deduction. By doing the cash balance plan, you're going to get such a big deduction that you may be able to get back under the thresholds to take advantage of either the 20% deduction or just the general lower tax bracket. So it really is a really great planning tool.
It's just a couple examples. A law firm that wins a big case, and they have a tremendous influx of money. That would be a case where maybe you want to front load that plan a little bit because you have access to that sort of windfall. We've had solo K business owners. They have a solo K. They have no other employees, and it's a great way for them to again, take some more tax deductions and put away some additional money. And doctors groups. We had a vascular surgeons group, 5 doctors, all of them making, paying themselves about $500,000 a year, just a few rank and file workers. And in this one scenario, we maxed out the 401k, maxed out the profit sharing, and they were able to do anywhere from 75 to 125 each in addition, while, still giving some to their employees and able to go over that statutory maximum by a significant amount. So that really worked out well for them.
Yeah. And I would think, when we look at the different exit routes, if you're looking at transitioning your business either to insiders like a key management group or maybe even to family members, you have to anticipate that you're probably not going to realize full value for your company. Number one, because the insiders probably don't have the funds to pay full value. And number two, if it's going to a family member, you may just want to give them a discount anyway. So knowing that you may not realize full value upon your exit, having a really strong retirement plan balance, like a cash balance plan would allow you to do, can really make a difference. Because like Pat mentioned in the beginning, if you've got a substantial amount of assets outside of the value of the business, then you have a lot more options when it comes to transitioning the business.
That's another good point. So when you're looking to transition a business, and as you mentioned, most business owners are either going to sell to a third party or sort of transition to a family member or a current partner, or they're just going to retire. And in all of those instances, the cash balance formula is going to be disrupted because typically the person who's leaving is going to be the owner. He's going to be the oldest, and he's going to have the most money. So you have to decide whether that plan is going to survive that sale. And there are some, a few things that you need to do to wrap up the contributions that you have to make. There's typically a final contribution that needs to be made. The TPA and the actuary can help with that. But it does allow the owner, who, as you said, may not get a full value for their business, to have something else to sort of rely on when they make that decision.
Yeah, and the only other point I would make about as far as exit strategies, we all usually talk about business valuation in the context of it being a multiple of earnings or EBITDA or something like that. So business owners need to be aware that if you have a big cash balance plan, obviously your EBITDA or net income is going to go down. But from a valuation standpoint, that would be considered an add back. So a buyer for your business would take a look at your real EBITDA or net revenue, whichever they use, and they would add back the cash balance plan to come to what they call normalized earnings or EBITDA, and that's the number that would be applied to the multiple to determine your value. So the bottom line is you're not hurting the value of your business by adding a plan like this, even though on an annual basis it is going to reduce your net income.
Right, that's important.
Yeah, it is important. And actually, I wanted to see if Erik wanted to weigh in on this, because I know, Erik, you as a financial advisor, you're working with business owners. I've actually worked with you and serving some clients, and you're thinking comprehensively in regard to how they're exiting. Would you have anything to add to this in regard to the nuances of the cash balance plan as it pertains to, the various exit routes, selling to a third party, transitioning to insiders, family?
Yeah, I think in the context of a successful exit, being a part of a successful retirement, that big transition out of the company, you're going to very likely need something outside of just the business valuation. And the question really just becomes, what's the most tax efficient way for me to get that balance, going alongside parallel to a hopefully rising valuation on the business. And so I think that it's again, this is a tool that can be used to, maybe it does drop us into a lower tax bracket. Maybe it does, lock in some key employees that are going to be part of that transition, because they're being taken care of to a certain extent within the cash balance plan. So I think it's just in the context of conversations that I have, again, on the comprehensive dynamic of a full retirement plan with the business exit, that liquidation event only being a component. I think that, again, having something growing outside of it tax efficiently, it's tax efficient to the business in the meantime, is an incredibly powerful tool to sort of have in the toolbox.
So let me ask, what happens to the plan once an owner transitions out of the business?
So when the owner transitions out of the business, like I said, that is going to have a huge impact on the calculation. And again, cash balance plans, it's all based on an actuarial calculation. Who's in the plan, how old are they, and how much do they make? And typically, an owner is sort of the linchpin. And once he moves out, more often than not, that plan may or may not be viable. Often cases, it's not. What would happen is we would take a look at the current, maybe there's a new owner, a third party coming in, or maybe it's just a partner, or maybe it's one of the employees or one of the family members, have that calculation redone by the actuary. Then a decision will be made by the company whether it makes sense to keep that plan in place. And it's going to be different, obviously, but depending on the makeup of the folks who are running the show after the owner leaves, it might make sense to continue with.
Yeah, I think it all comes down to what those numbers are going to tell us. We've seen it go both ways, where maybe it isn't the owner exiting is maybe he or she's 70 years old, but there's another generation of family members that are still that small group of high earners within the company. Maybe it makes sense to continue on. Maybe again, the cash flow has been there. It will be there. We can afford to sock this money away, again, on a very tax-efficient basis. Same owner exits, and now all of a sudden it's, maybe a group of key employees in their 40s, 50s, that just aren't there from a retirement planning perspective. That's not their. The numbers just don't make sense, and it could very well, as Les described, the actuary could come back and say that now that older highest earner employee is gone, you now owe the rank and file a much larger percent of the ultimate contribution, which again might not be the main objective of the new ownership group.
Mm-hmm. Yeah, a couple of different scenarios where we see, Walter, where this can be particularly helpful, cash balance plans, is certainly in a lifestyle business, right, where you're not looking to get any value out of the business eventually, and really when you've got that situation, you're absolutely looking to accumulate whatever you can accumulate outside of it. Another situation is when we go in sometimes and expose reality, if you will, and assess where the owner is. Maybe they are a baby boomer, mid-60s or something, and they just don't have. We've gone in, we've exposed reality, we've assessed their readiness on the personal side and the business side, and the reality is the business, it's going to take 5 to 10 years to really accumulate the kind of value or grow in value to where they'd sell it, they'd accomplish all their goals. And they may not have the energy for that. They may not want to do it. They may just decide, you know what, I'm going to start to sock away as much money as I can outside of the business rather than trying to put all this effort and money into growing the value of it. And that's another scenario. Can you think of any other scenarios, Walter, that we run into that?
I think just the ones we discussed, the one you highlighted in the beginning, where because the business owner was so successful in accumulating outside funds that he had a ton of flexibility when it came time to exit, and was able to successfully transition the business to an insider and family member.
Yeah, I think just what a weight off your shoulders from having options in that scenario, knowing that you have this balance growing, 401k, profit sharing, cash balance, all working together. And that you could get an offer for your company next week for a number that, maybe you have a 5-year plan to double your valuation, from $2 to $4 million. And that would, be wonderful. But if, someone walked in the door today and offered you, $2.2 million for it, and you knew that because you had the balance outside, you could take that check and move on to your next venture, or, really consider retirement. I think just having different outs other than just that one liquidation event that so much has to go right, incredibly powerful. Yeah. And, it could very well just lead to exits that you had never even considered. And not having that balance outside of the business valuation just really limits those options. And I think you hit the nail on the head. So many business owners, they're plowing every last cent back into the business. This is really a way to start to extract that value, under an account in your name. So that, it's not every penny's going back in, and you end up, 73 years old, having to sell the business to take care of you and your family. Maybe the market just isn't the right time. The market doesn't care that you're now looking to exit. It could just be a really bad time. So, we always, from an investment perspective, we're always talking about diversification. This is a way to diversify your overall life's portfolio. Again, in a very, very tax-efficient way.
Yeah, so a key point, listeners, is that an owner who has a sellable business is going to have more options for exit. Again, using the example at the beginning of the podcast, the gentleman who was a client of ours, because he had a sellable business, he had options to sell to either a third party or the insiders, like he ended up doing. And then also to create more options, the more you accumulate outside of the business, to Erik's point a second ago, you're going to have more options and more flexibility as well. So as we wrap up here, Les, how do you recommend an owner go about, let's say we've got listeners here today and they're thinking, yeah, this could be a good idea for me. How do you recommend an owner go about deciding if a cash balance plan should play a role in the retirement plan or exit plan versus another plan like a 401k?
Well, the cash balance plan is typically added on. It's a supplement to the 401k. Uh-huh. So if an owner has an owner-only 401k, a solo K, or if they have a traditional group plan, safe harbor, if they're at the point where they're maximizing their contributions, if they're at that $62,000 annually and they're really looking for two things, more of a tax deduction, and they really want to put some additional money away, those are sort of the two indicators that they should reach out to an advisor like Erik, who works in this field, who could guide them to a third-party administrator or an actuary who can run some test scenarios, and that we can figure out if this is a good fit for them.
So, Erik, if one of our listeners today is interested in doing that, how do they reach out to you?
Reach out directly to me by phone, 202-955-4318. Email EFROMM, 2 M's as in Mary, at Janney, JANNEY.com. You can go onto our website, csgretirementsolutions.com. Again, all the contact information there. And again, it's really just getting an understanding of where you're looking to go, what's the sort of the general objective, and then again looping in the necessary parties. If it's a TPA, it doesn't cost anything to run those actuary numbers. It's really just what are you trying to accomplish, and if a cash balance plan is the way to go, great. If not, how can we make sure that you're fully maximizing the 401k profit share combo? Is it a non-qualified deferred compensation? There's a number of different routes that conversation can take. Again, really just can't give you a good answer until we just have a sense of, let's talk about what you're really trying to accomplish. Tell me about the business, who's involved, demographics. Make a huge impact on this particular plan, especially just because of the actuary involvement. But yeah, it's really just getting a conversation started, and using us as a conduit to whatever plan makes the most sense that's going to help you hit your objectives.
Fantastic. Is there anything that you guys wanted to promote today? We like to ask that at the end of the call. A guest, anything? Products, services, events, anything?
Well, I mean, really, when in the context of this conversation, the retirement plan as part of your benefits package, it is just such a vital component to, employee engagement with your full benefits package. One thing that we like to highlight, we don't do health benefits, but we're really very concentrated on full employee engagement across your benefits package. It all impacts the sort of dollars and cents for you, the owner, and your employees. And so I think that we're in a unique spot as financial advisors, retirement plan advisors, to be face to face with you, the owner, and your employees, talking through how all of this stuff that you're offering, you spend so much time, money, and energy on your benefits package. We want to make sure your employees get it. They're taking advantage of it. And look, you're typically, as the business owner, the biggest participant in that benefits package. So yeah, we want to make sure that they're all working together, with your health broker, everything from HSAs, all the way down through just the, basic retirement planning. So total employee engagement is really what we're most focused on as a group.
Fantastic. Thank you both very much. This has been very enjoyable and very educational. So thank you both for joining us today.
Thank you. I appreciate the time. I'll be rooting for your Redskins this weekend.
Oh, yeah, I guess you will. Maybe you're hoping we do you a favor. I wouldn't count on it.
I'll say no Fina. It'll be good. I got faith.
Yeah,
so,
hurts.
Listeners, to begin now in planning your successful exit or just building up the value of your company, check out exitreadiness.com for an online course and resources to increase your knowledge, assess your readiness, and start your planning. If you'd like to speak to either Pat or myself regarding building the value of your business or planning your exit, you can reach Pat at 301-859-0860, and you can reach me at 301-951-9090. Until next time on the Exit Readiness Podcast, this is Walter Dial and Pat Ennis signing off.